Alright, now in this video we're going to look at some order blocks and what they are and how we can identify them, how we can draw them in. Now mostly order block is the name for what we actually have already done, but it's good to know some of the technical terms because you might hear them around and you might not know what they're talking about. Now an order block is a price range where the banks have placed their orders. Now call it banks, call it hedge funds, call it regular traders, it doesn't matter. An order block is where we think the orders are, basically, and that is a place where they bought heavy and sold heavy, which brings me back to the same thing. We're looking at where they bought heavy and sold heavy. The market will return to these price levels, and if the level is a correct order block, it will not get violated. Now, it may not always come back to these levels, but if it does, that's when we're going to trade. The time zone, the time frame doesn't matter. The bigger time, the smaller time frame, depending on your bias, you're going to mark these levels out just like we did with this. Okay, this is a level where they bought heavy, so yes, it's an order block zone. This wick is a place, as you can see, where they bought heavy, so yes, this is an order block zone. Okay, so let's take a look. Identify the range of the market where the reversal happened. Take the last bearish or the last candle before the up move when reversing from the lows, or take the last bullish or the last candle before the down move when reversing from the tops. As you already know, we did this as well. Okay, so we're just defining what we did. So the market, let's say here for example, this is an order block, okay, because this is a block where the market sold heavy, they broke below the support, closed below it. Now if you take a look at this, they didn't close below that level. Alright, they didn't close below there. Let's just do this for the sake of the example. You see, it didn't close underneath it, so this is bearish actually, and it's a good thing that we had a swing day. Okay, so this worked out nicely on a swing day, on a swing hour, and the market pushed up. That's good to see. Okay, so what we need to do is just identify these levels, and they're called order blocks. Nothing we haven't done, it's just its official name. Okay, and what I'm talking about here is the manipulation bar, so the last blue bar before the crash down, the last red bar before the market rushes up. Okay, and that's basically what we're talking about. Now if there are a few ones and you're not kind of sure which one it can be, okay, then you've got timing on your side, so you're okay with it. If you are finding it difficult to find, well, which one is it? Is it this one, or is it going to be this one, or is it this red bar? You know, first of all, look for the one that caused the breakout. Okay, so for example here, if you take a look, let's make this a little bigger, and if I go back, so as you can see, this is, let's see, the open was 20,014 and the close was 20,004, so this is actually a red bar. Okay, and it caused the breakout. You see, that's the resistance, so we'd mark this in. Alright, so if I was to now narrow this down, so that would be our bar to get in. Okay, there you go. And this is where the market bought a little bit but still broke down, and sometimes that will happen. But look, on the initial one they bought again, so you would have been okay, you would have covered the trade, took some profit, and then the market crashed down. Okay, so look for the one that caused a breakout, and don't just go for any old red bar here or here or here. You've got to make sure, you know, it was a place where the market took off like a rocket. You see that? Boom. Okay, and so on. Okay, has levels of imbalance and gap or inefficiency been filled? So this is obviously something to look out for. Always check the gaps, because if you have a gap underneath a certain bar they'll want to come and fill it in, just like this 4-hour example we had. Remember on this one where when they on the Nasdaq example, you see how they filled in the gap. So if somebody was taking this bar, causing a breakout, let's say, and you didn't take into account the gap, that would be silly. Okay, so look for the gaps, because the market will want to come in and fill them in. This is on a smaller time frame, on a big time frame, it's the same thing all the time. Okay, volume comes into play and it breaks a significant swing. The break can be a lower, higher wick, liquidity sweep, then market should move towards the order block. Now this is also interesting to see. Sometimes what we will see is we'll have an order block. Let me see if I can actually see one here. For example, look, this one. Let's just take one as an example. I'd like to see if I have an example here, something nice. Let's see. Okay, so let's take this one. This one looks like it's been swept. So look, here is the bar. This is an indecision bar. You can take an indecision bar if after the indecision bar there's been an up move. An indecision bar means the open and the close are the same. Okay, we're like indecisive. Now what you can see here in this zone, the market goes up, breaks that, change of character, breaks that, break of structure, and moves up. You see when the market comes back here, everybody's stop loss is under that level, so they sweep them and then they go the other way. Okay, see, once again there's a big fall. After the big fall, stop sweep, market comes up going the other way. What's going to be important here for us is obviously timing. Okay, so we need to check the timing. So we have a zone. In this zone, what time is the market likely to turn, or also is there a swing day? Okay, so these things we need to check. So looking for these stop sweeps are important. Now here I've got also volume comes into play. Sometimes you'll be able to see volume, but volume is normally a service that people pay for, because on a MetaTrader 4, 5 or any platform you can't really see the volumes. Okay, volume can only be seen at the stock exchange data, where people are really buying and selling those things, and you can see the volume. With currency transactions, it's really impossible to see the volume. It just isn't, because it's 24/7, it's happening all the time. So when you're looking at, if you're looking at a volume indicator, you really need to be cautious, because it's very, very impossible, very much impossible to track these volumes for unregulated markets, like over-the-counter markets, like Forex, for example. Okay, Forex happens between banks, and you can't really keep track of how much of the euro-dollar volume is being traded all the time at the realistic level. With stocks and shares, indices, the index that it's traded at, the stock exchange that it's traded at, will have volume, but you'll have to pay for that volume information. So this doesn't always is not always trackable. But what happens is, what I'm trying to say here is that a push of volume and action will come into play. Okay, it will break a significant swing. Then the break can be a lower high wick, lower or a high wick. In this case it was a lower wick, you can see. Okay, and then once the market does the stop sweep, then should move towards the other block, the order block. All right, so we've done the stop sweep, as you can see. Now we're going up into the next level, and the next level is here. As you can see, there was a bit of a gap here. The market fills in the gap. You see now how we're moving from block to block, and you can see the red bar here. Its wick is there. This is why I take that as well. And you see, comes here and then goes back down. Now when it comes back down, you just have to follow it through. Let's now take this. This is the red bar, okay, and the blue bar has a wick there. So the market comes into there and then goes back up. Now it breaks this level, and you see there's a gap here. the market will want to fill in the gap. That's your order block there. Okay, so if we extend it to there now, okay, there's the selling orders coming in until, look what happens, it's breaking. See the big move? The big move comes in. That was your level. Okay, whoops, but we want to take the high of that red bar. Okay, so the market breaks out. Okay, now we have a breakout. Now this order block, remember what I said, this order block now becomes the support. Okay, so now what do we have? We have a gap. See how the market now fills in the gap. Where's that gap between there, oops, and, well, there's not much of a gap really. Okay, there isn't much of a gap. There's the gap of that high, and that's filled in there. So it's going to be this bar, isn't it? So all you have to do is just follow it around, just like that. Okay, obviously working from the bigger time frame, moving into the smaller time frame, matching it to your hours, and when those moves happen, you have to be looking out for stop sweeps. I often mention stop sweeps. The market will go down somewhere quick and quickly move up, just like in the indices example of yesterday, or Nasdaq, Dow Jones. Check levels of liquidity. Remember liquidity? Where is everybody's stop loss? Everybody's stop loss is always going to be above the highs and the lows. All right, that's where the stop losses are. So if a market, let's do this, okay, if there's a high, people's stop losses will be there, and the market will sweep it and then sell. Okay, if there is a stop loss, it will be below there. They will sweep it and then buy, and then they sold again here, as you can see. So look where the support resistances are on the daily, weekly, monthly, or the 4-hour if you're intraday trading or day trading, so you can spot those levels. Then don't get stopped out. Okay, sometimes we'll have a trading hour. I've mentioned this before. Sometimes we'll have a trading hour and there'll be, let's say, a gap that the market wants to fill. Let's go right to the top. What will happen is this: if the market, let's say my trading hour is on this bar, right? The market goes down, fills in the gap, and then it starts going back up again. So if there is a gap, I've got to keep this in mind, okay? Because the market will want to fill it. The hour is correct. Okay, we are pretty much on the dot more often than not, but sometimes there'll be times when the market will want to fill in the gap. So you can wait for that, and you can set up accordingly on a smaller time frame, change of character, break of structure, and follow it the other way around. You don't have to rush the trade. Let's go here. Now these are some examples. As you can see, the market doesn't work always, you know, in this perfect way, and you have to draw your lines, obviously. And this is why in the coaching program I touch a lot on drawing your lines. So you must make sure you draw your highs and your lows. This is, remember, pretty much like my previous example to you. Remember, I said, guys, I have these lines because I want to see where the highs and the lows are. The high of yesterday, the low of yesterday. I want to see these points, see how the market goes down into those zones and starts to pick up. Okay, so by seeing these levels, the highs and the lows, I've got these lines. I can really see where we're going to fill in gaps, where we're going to stop people out, where the stop levels are, and so on. So learn to draw those lines for yourself, and by taking the highs and the lows, you can do that easily as well. And like I mentioned yesterday, I've got the pivots and the openings and the closings as well. Okay, so make note of that, because they will really give you the heads up. So if this is the low of yesterday, you got 3 lows there, everybody's stop loss is underneath there, so they take them out and then push up. Now you see the market breaks the structure. I've got a change of character, break of structure, the market comes back down into the zone, and then it starts to go off. Same thing for the opposite side here. The market gets stopped out, big push down, you got a going up into the supply zone, it's an ABC retracement, and then a sell-off. Okay, so look out for these things and practice them on the chart. You will see them if you draw your lines. Okay, then you can use them for setups with your timing. Here is an example. Here's an example with on a live chart, as you can see. Now once you get into the details, nitty-gritty, you'll see that it's not difficult. You just need to figure out where the lows and where the highs are, and you want to sell the highs and buy the lows. This is why in many of my videos you'll hear me saying, guys, don't trade in the middle. Okay, trade on the edges. You want to buy the lows. You want to sell the highs. Okay, but you know, don't muck around in the middle, because you're going to get chopped out here. This is a dangerous situation. It'll be on everything like that. Let's take a look at, let's see, SP 500 here, and the same kind of thing. You see where the market, they're selling at the highs. So if you want to sell, you got to sell the highs, and this is why, you know, the highs and the lows of the day is important. Okay, remember how the market rushed up yesterday, came to the pivots, and then down again. So understanding where to trade in your order block determination is crucial, and the highs and the lows, if you draw your lines as well manually, if you draw them too, you should be okay. Even if you just draw a high here from yesterday, you see this is where the market sold off. There's a bit of a, is there a gap? Let me just see. Not particularly, it's just a very small place there, but still, as you can see, the market goes there and they sell off. Okay, so by understanding these levels or zones, you can, all you have to do is just get into the zone where they sold, where they bought. You can do it on a big time frame, small time frame, on a half an hour chart. I don't use half an hour charts, but I know some people do like them, and if you can spot your levels, then go ahead. You know, it's not a problem. That's your blue bar. You got a red bar with a wick. You can take that. That's your zone. Okay, and you see the stop loss sweep here, sweeping, coming back down, selling off. Classic. Okay, so by marking these in, matching it to your hours, you're really going to increase your success rate. So figure them out, draw your lines, and you can see the market changing character, breaking structure. Once it starts to do it, you see the reaction. They're buying, and then all of a sudden it's going, comes back to the manipulation bar here. Right here, let's take a look. Look at that. That's your manipulation there. Okay, so the market coming into there and then going back up again. All right, and then we have another break here, as you can see, the market coming back where they bought, just a little bit of a gap there, but nothing material, and then buying again. So you want to buy where they bought heavy and sell where they sold heavy, and all you have to do is match your hours and your days, and that's the way to go. All right, so this is why time and price trading is so much more easier, because you understand there's a time and a price. Okay, so let's see what else. Now here we've got the same for the sell order block. Is an example here. As you can see, the market is once again they're doing the same thing. You see where they sold heavy, market breaking structure, quick push down, and then market going up again. So you see here the breakout traders, they're all excited, they sell, and then the market goes up quickly here. Then the guys who are selling here, okay, they're all excited, but their stop loss is just above there and they get stopped out. So selling here again is happening, just like in this example we just saw now on the chart. Okay, same thing, remember? That's your zone. Market sweeping stops and selling off. Now remember, it's the blue bar, that's the manipulation bar when you're selling, right? But on the right and left, I'm checking if there are any wicks, and if there are, I'm taking the high, because I want to make sure, you know, if we're going to get stopped out, swept out, I just want to make sure. Once this thing happens, if it matches your hour, then that's it. You're on the sell side of things and you just push forward. The market is already going down, so selling is logical, as you can see. Then all you have to do is follow it through. Now look at this. The market is pushing very quickly. You see? So a big sell-off is probably going somewhere, and it might be bought again. So if I was to buy again, where would I be buying? Okay, so we'd need to come back probably into this zone or into that zone according to the half an hour chart. If I was to take a 4-hour chart, okay, I'd like to see me come back into, let's make this a little bigger to see if there is anything, maybe the pin bar here if I wanted to go long again. Okay, so I'd take this range because that's a long pin bar. I'd like to see that happen. Okay, but if the market came back into this zone, right, and if it matched a swing hour, should we go long? It's a question, and it is worth doing because yesterday was a swing day. All right, so the market coming back down for us to go back up again is logical. So let's see how far can that come back into. That was a high and this is the low. Okay, let's do this. So if we get back into the 50 zone, it's doable. The 37.5 is doable. And if I make this a little bigger to spot these manipulation bars here, where's the one that caused the breakout? Here it is. Okay, in fact, this is the one here. So this red bar now becomes interesting. So if we fall back into this zone and the market wants to buy, if it matches our timing, we can buy again with a tight stop loss. The bigger time frame is to the downside, obviously, okay, but we can do it because we had a good lift up. We can come back, and in our trading hours, that line slightly below it, the 50 to 37.5, if the time is right, we can go long again. All right, see how it's like pushing in quickly, you know, sell off quickly, and then obviously somewhere it's going to be bought along the line. We need to match time and price. Now the rules for choosing correct order blocks. Time of the day is important. Why? Because the volatility is in London and New York. But if you know the trading hours, you can't follow 16 hours of a market, 8 hours London, 8 hours New York, plus the pre-trading session, which takes about an hour and a half. That's going to give you like, I don't know, 17, 18 hours of market time. You can't trade like that. It's just not going to work out for you. So if you're trading with the GlobalTrader.Club, what you want to do is you want to match the trading time of the day to your technical analysis. News events, we don't really care about news events when we're trading with time, but I do keep track of the news events, because if I have a trading hour close or on the news events, then obviously that news event is going to be exciting for us and it's worth taking a trade, simply because we understand the market's going to move there. So knowing when news is coming out is important, so we can match if we have any trading hours before or after. Fundamental analysis, the only thing I can say about that is always go with the higher time frame, because the bigger time frame is really the main sentiment of the market. Other than that, I follow no fundamental analysis at all. I just check out the news events for the timing of the trade, if it matches our trade hours or not, and the fundamental I just get from the bigger time frame, because there are just too many news all over the place. Fast spike moves into your price levels of interest. Now this is obviously, like I said, it's important. If I've marked out a level and there's a sudden move into that level, and if it matches our hour, that is the time when the market is going to go U-turn. All right, so you can look for a setup in your smaller time frame when using demand and supply. So if you're using, let's say, 4 hours and 15 minutes, then you can go into the 5-minute and 1-minute charts and watch for a change of character, a break of structure on the small time frame, the 5-minute and the 1-minute, and then on the pullback you can get back in to the game. Okay, or if you're using daily and 1 hour, you can do it on a 15-minute chart. Okay, depending on your style of trading. Okay, look for imbalances, which are gaps in the market. So this is something you always need to keep in mind. It will get filled out sooner or later, and when it does, you should be there, especially if it's a swing day and a trading hour, just like with the example on the indices. Okay, easiest way to think of this rule is the wicks of candles must fill all the prices. Okay, but I've made a note here, this is not a trading criteria on its own. You can't just trade on gaps. Okay, and because price moves from liquidity to liquidity, you must always check out where the stop losses are. This is why putting your lines, drawing your lines, is really important. I often draw channels, as you can see as well, on my day-to-day chart as well. You can see all the time I've got lines all over the place. Obviously not, all over the place. When I say all over the place, the main ones, for example, if we take a look at the daily, weekly and the monthly, for me they have the same template. So for example, here on my SP500, you can see I'm just drawing channels, a few horizontal lines for checking out gaps, and I got my Fibonacci here, and obviously the PST pricing for me is very important, but if you don't have it, it doesn't matter. The important thing is you understand how your trading is going, in which direction you want to go, and so forth. Okay, so let's get back. Now, imbalances allow you to anticipate the direction of the market. This is really true, because as we just saw with this example here, if I see a gap, okay, I want to make sure that it's filled in, and once it's filled in, it's like kind of like that's it, we're kind of like okay to go the other way around, obviously with our timing in correlation. So you don't want to just dive in, you want to correlate it, align it to your trading hours as well. So here we have also, once again, a big push down. So two things can happen here. If we break out, a pullback into a trading hour is going to be a good buy kiss to this zone, then you can go long with it. Or we're going to go up, okay, and we're going to sell again, okay, and push further down. Okay, and how we're going to decide on that? Well, you can only decide on it once you plan it. Okay, and if your bias is to the downside, then you're going to have to mark your levels. You're going to keep in mind that there are gaps up here, and if it does go up, check out your Fibonacci levels and where you fill in the gaps. See how nicely that's aligned. It's our Fibonacci zone. Okay, let's do that. That is exactly where the gap is, and this is exactly where the manipulation is, and that's your red bar there. So we're pretty much in this Fibonacci zone here, there, right, at the 161.8. Okay, so now if you wanted to go up on the breakout, the pullback into a trading hour is okay to flow into this zone, and that also makes an intraday trade. So if you understand the direction, the swing day, the swing hours, you can just follow the price action with the time as well. Looking out for these imbalances obviously is important. Some supply and demand zones work and some don't. What to look out for? Obviously, if you're trading swing days and swing hours at the GlobalTrader.Club, then obviously you'd want to match your swing day and swing hour. But if you're not, then what you can do is, rule number one, look for imbalances of demand and supply, where the demand is much greater than supply, or supply is much greater than demand. So where those breaking of support and resistance levels happened. Okay, so those are going to be important areas for us, where they sold heavy, where they bought heavy, where the market broke out. And then these locations are your trading zones, the tops and the bottoms. Okay. The second one is levels in the middle are choppy regions and risky. So don't do trades in the middle somewhere. Like I always say, trade on the edges, trade on the edges of the highs, trade on the edges of the lows. So that way you're more highly likely to get at least enough profit to cover your stop loss or to manage your trade and so on. Otherwise, if you're not trading on the edges, if you're in the middle somewhere, you're taking a bit more risk. If you do trade with hours of levels like daily pivots or weekly pivots or whatever, you can, if it's in the direction that your main bigger time frame is going, and you can do it with a smaller lot size. So if you have an understanding, it's not a problem. But trading in the middle is very tricky, and don't just trade with time either. Match time and price. Look for break of structure and then levels of inefficiency for the retracement levels. Now this is basically when a market breaks out, sometimes what we'll see, let's see, for example here, you see this breakout here. This is a huge breakout on the euro dollar. And once this breakout happens, you see the big gap. Okay, so the market will want to fill it in. So obviously, mucking around here, trying to get a few points and trying to make a few bucks is not the way to go. What you want to do, this is a level where they sold heavy, and see how they stop sweeped everyone. Remember, this is your zone. Okay, this is where they sold heavy and they broke the support, closed under the support. So that's your zone, right? And this is where they stopped sweeped everyone. But luckily, obviously, we knew the swing days and the swing hours. So I was always saying, guys, at swing hours, trade the highs and sell, or look for a sell setup. And this is exactly what happened there, as you can see. So following this down to close the gaps is logical. What can you do here? Well, what you can wait for is a break of this level. Market will break this level, it'll close under it, okay, and then when it goes back up again, you'll want to sell it off. Well, where will you want to sell it off? Well, you'll want to sell it off where they sold off before. So that's your blue bar, that's the high wick on the red. So then this will be your sell zone. Okay, so if it breaks below, comes back up here, you can sell here. There are no gaps on the daily. You can check if there's a gap on the 4 hourly. Maybe they'll fill that in. Okay, so this might also be a sell zone if the market goes up on a 4 hourly. Okay, and that's basically it. There's a slight gap there. They might do a stop sweep to fill it in and then sell it off. So these principles, once you mark your levels in, really all you got to do is just match it to your time, and you should just trade when price matches time. All right, so looking for these levels where the market is stopping people out, where there's liquidity, is important. Also, if you know technical analysis, if you have a U-turn strategy, if you have a divergence strategy, if you got a strategy like us, I use divergence often. Obviously, timing the trades for us is always on the cards. So swing days, swing hours, and looking for confirmation with a U-turn, or on the smaller time frame, You can look for a change of character or a break of structure, go down into the 5 minute, 1 minute, like I said before, and you can do those as well. So some will work, some won't, but if you cherry pick, which means, you know, don't go for this one when you see there's a gap down here. So, you know, be sensible. Don't pick this one when there's a gap here, because yes, this caused a breakout, great, but there's a gap here. So if it comes down, your zone is going to be that red bar plus the full gap here on that bar there. So this whole zone is going to be your level. Do you see what I mean? And then you can narrow it down into a smaller time frame when the market comes here and match it to your trading hours. Very practical and easy. Okay, so using order blocks and imbalances to trade, these are a few principles of how things pan out in the market. So market makers take out all the stops with a stop hunting move. This happens often. These are the sudden moves in the market. Sudden move down, sudden move up, all of a sudden taking stop, doing the stop sweep, and then going in the other direction. Then there'll be a break in structure. The market will start to reverse. You can spot these in the smaller time frame if you're entering at those zones. Okay, and then the price will return to the next order block on the opposite side. So if they bought, they'll want to take it to the sell order block, and then they'll battle it out there whether they want to sell or whether they want to buy. So this is like pretty much the steps that it's going to happen. So as you can see, the market is going sideways, even highs, even lows. Market takes them out, and then goes the other way. Now you see the gap here. If we wanted to buy this, we'd need to come back to fill in the gap and then go up. All right, it also broke the low here, as you can see, so that just took everybody's stop losses out, quickly dashed back into the market, going all the way up. So now what you need to look for here is a pullback into an order block, closing the gaps, and then going that way. All right. The opposite can be, the opposite can be true as well. So the market comes here, okay? So there's a bit of a gap here, as you can see. So the market, if it comes back, they'll want to go and close this gap. Then you'll want to be looking if you want to be selling at this order block, okay, depending on the bias of your technical analysis. And if you match it, like I said, to time, that should be all good. So there are a bunch of examples here. As you can see, it's worth looking at the market in live trades to spot these out. If you trade in, lines like I do, things will become more obvious, in my opinion. It's just a tool you can use, and that's it. The keys to success here is always work with higher time frames and then come to the lower time frames to refine your entry and use your timing. If you like, use other technical analysis tools as well. I always do. Fibonacci, waves, astrology, timing, etc. Ensure money management is in place with risk return beyond 1 to 2 at least. I prefer 1 to 3, but it's a matter of choice. When you're trading with time and price, you should get much more. 1 to 4, 5, 6 is all doable. So, if you kind of get it all into an alignment, you should make much more than your risk for sure. And finally, I've made a little summary here, things to know as well. These are important things. Fail swings as well. Liquidity, you already know where the stops are. So where the double tops, double bottoms, triple tops, bottoms, the high of the previous day, the low of the previous day, the same for the previous week and the month. Those are all levels where there'll be stop losses, okay? So people in the market will want to hunt them. So you should check if your order block fits into those levels where there's liquidity, where there are gaps, and so on. And then we get fail swings when the price fails to break the last swing top bottom. implying a reversal of trend. So this is something you can look out for as well. What will happen in the market is this one broke out, as you can see here on this swing. This is a 4-hour chart. It did break out, so it's actually bullish, this one. So market wanting to buy again, as you can see, is logical. But you see this next one here, it just doesn't do it. Okay, and then what you have is the market breaking below and closing below it, and that is just giving you a sign that, okay, we're like bearish on this one, pushing down. So sometimes the market will go, it just fails to close above the next swing and then comes down. This will be for anything and everything, as you can see. If it doesn't, for example, with gold, we've got a really good trend happening, as you can see. This is a very, very strong trend. So what you don't want to be doing is standing in front of it, unless you've got a price target, because these are all-time highs, right? So you have to just make sure there's a good pullback before you get back in again. And you can see we marked those levels in from the other day, and these are the levels at least you need to expect before going back up again. You can see there are no gaps here. They've just closed everything nicely. Right, it's a 4-hour chart, but there is one here. So the market needs to come back sooner or later to fill in some of these places. And if I turn this into a daily, it'll be more obvious that this zone is something we'll be looking at. Okay, there we go. So once the market breaks a level, this is a break level, okay, it needs to close above, and then you can just follow it through. If it doesn't break above and then pulls back in, then you're obviously going to, for example, like here, okay, the market went up, it couldn't go above that bar, it did a stop sweep on the high of the red and just tumbled down. Okay, filling in the gap, as you can see. So once again, coming back, filling in the gap, and then just taking off. Okay, and then you can see here market doing a change of character, break of structure here. Okay, so once they fill in the gap, you can see here change of character, break of structure happening, higher highs, higher lows, and that's it, all the way to the moon. So if you're following an asset constantly, you should be on top of your game. Okay. Entry to the trade, you can enter either at the latest swings, breakouts, retracement, or after the impulse waves retracement. In either case, you're going to wait for the market to come back to a cheaper price, and that's the way to trade. If it goes up quickly, you got to wait. So on gold, I'm not doing any buying at the tops here, because for me this is just extreme levels with a lot of gaps in place. So why take the risk? Okay, I don't want to be selling against it, and I don't want to be buying at the highs of the market when I know that sooner or later we're going to come back here. A lot of people force themselves into a trade. Don't do that. Just let the market pan out. There are other things to trade. You can trade indices, you can trade, you can trade anything. You can trade Bitcoin, Ethereum, and look at all these things, filling in gaps, coming into the order block where the market broke down. This is Ethereum. That's the red high, as you can see. So I'm taking that level. This is the stop sweep. See, the market is not closing above that. This is the manipulation. It caused the break of the swing. Market closes below, comes back, stop sweeps, closes underneath, and we're going the other way. Okay, so this kind of stuff, you've got a chance where things are not risky, and you can play around with them, and you obviously have prices at these levels before. So you can like play around with these levels because you've got data. When you're at all-time highs, things are much more difficult because you don't know when they're going to do a sudden surprise sell-off. Okay, so for example here as well, look, the same kind of thing. Market stops sweeping and just crashing down. Very easy to trade these things. If you've got the lines, if you have the swing days, you've got swing days, swing it off. You can match this to Bitcoin. If you learn it yourself, you can do it yourself. This is, let's see, if we had a swing day on the 16th or the 17th of December 2024. All right, so 16 to the 17th. So Monday, Tuesday, I had a swing day for Bitcoin on a Thursday, Friday. Okay, and that was it, Thursday, Friday on that week, 16th to 20th. So that's your Monday, that's your Tuesday, Wednesday, that's your Thursday. Okay, so Thursday market swing going upwards. All right, it would be interesting to see if there was a swing day there, which is the 6th, 7 or the 8th. 6, 7, 8. Let's see. I don't trade crypto, but you know, we can check it out. So 6, 7 or the 8th. Let's check it out. Let's December. Oh, not there, sorry, November. All right, so 2nd of December to the 6th of December. So obviously the 6th was a Friday. So what did I have? I had Thursday the 5th and the 7, 8. So if we take a look, I had the 5th, which was this one, and then I had the weekend 7, 8 there, you can see. Okay, and then the market turns around. That's a retest, stop sweep, and then bang down. All right, so that's how you can basically use your timing, and you know, take it from there. 6, 7. If you want to check the others, I've got them all on the archive, so all you have to do is go into December and then 9 to the 13th. Let's refresh. All right, so that's your 19 to the 13th. So as you can see, I had Tuesday here, so that's the 10th of December, and let's see what happened on the 10th. 8, 9, that's the 10th of December there. The market rushing back up. Okay, 10th of December, market going back up. And then we had Sunday. So Sunday would have been the 15th. Okay, the 15th, let's see when that was. Sunday would have been the 15th, is there. Okay, that's the 15th. So from there the market went up here, and then a day or two after it did a swing. Okay, so for Bitcoin maybe it was a bit different. This is Ethereum. Obviously everything has its own swing day differently, but you know, if you want to match it to Bitcoin, you can see how things are panning, and you can, you know, expect when the markets are gonna turn and so on. All right, so let's see. There you go. Entry to trade, you can either at the latest swings breakout or retracement. Like I said, we're always looking for the market to come back to a cheaper price. Exiting the trade, you got to make sure you got a good target as well. I urge you to trade definitely with a target. Trade management, this is a must. You have to know when you're going to take profit, when you're going to move your stop loss, and when you're going to take your you know, stop forward, or take half a position, or completely close the trade, and so on. Or what are the things that you're looking out for that might show you or indicate to you that things are going the other way, and you should just get out and wait for a new opportunity. Okay, so trade management has a few things to look out for, and definitely don't disregard it. Now the rest here are a bunch of examples, and I tried to put quite a few in there. So these are all the things you should go through, but you should also check them out on live charts. You should go and just look for these things, because just looking at these shapes is not really going to help you out here. Okay, so just look for these breakouts where the market gets stop lossed, where the stop losses are taken out and pushed back in again. Why the market didn't sell here, but they sold on the order block of here and taking out stops. So these are important things to look out for. So I've tried to make as much as examples as I can from charts as well, so you don't just get stuck with a drawing like this. You've got to make these work for you on a real chart. So take the time, take the opportunity, give yourself the time, really sit down and see what is going on. Okay, and study the charts, because once you study charts, your eyes are going to get used to these levels. You're going to draw your lines, and then you're going to say, oh my god, this is a stop sweep, let me go long. Oh my god, this is a stop sweep, let me go short. Okay, obviously not impulsively, by calculating and doing all these things before. And if you're using timing, and if you match it to your timing, it's going to be much more effective. And once you see them in action, this is how you're going to be able to see them with your lines. You'll be able to draw those gaps, you'll be able to draw your order blocks and trade with price and time very effectively and efficiently, and you won't get chopped up all over the place trying to follow all these indicators like moving averages and MACDs and all that kind of jazz, because they'll always take you into the trade where the jazz is, because they're late when you're entering the trade. You want to be able to match a time and a price so you can get in early, rather than wait for a moving average confirmation or whatever, where you'll be in the trade just late. That also really hammers your risk return, because you're going to have to put your stop losses further away. So like I said, read a lot of charts, go through the material again and again, really chew it. And I always post videos. I do weekly wrap-ups. If you follow them, you'll learn a lot, especially after this course, because you've taken the fundamentals, you've taken the theory, you've looked at charts to apply it, and then time and price will become really practical and easy for you to use. If you have any queries, questions, feel free to always reach out. You can always reach out to me from my website. In the contacts page, you'll find email, my WhatsApp number, Telegram number. So feel free to reach out and ask questions if you have any problems. But like I said, you've got to do this technical analysis work so that you can kind of like match the time and the price, so you're not just dependent on one or the other. More often than not, I see people not taking the time and putting the effort in to really understand these movements in the market, and that will really be a problem in the future for you. All right, so don't do that. Okay, look at many charts as you can, like we did here. Look at a bunch of assets and go into the bigger time frame, small time frame, pick those days, pick those levels, and then work off them, and then you'll see you'll get better very, very quickly the more you practice. In the interim, all the best. I hope this course was helpful. Like I said, feel free to get in touch with me if you have any questions. Have a good day.